Hey there, fellow investors. Welcome back to another show of Sunday with European DGI. Today I've got actually quite a packed episode. There are three main topics that I would like to discuss. Firstly, I want to go with you through my quarterly one portfolio results. We've discussed it already a bit in the podcast, but I didn't have any visuals to support that. Secondly, I want to quickly go with you to the chip war that's going on, because TSMC also announced a $100 billion investment in the upcoming 3 years. And then thirdly, I wanted to look with you at the healthcare sector, because I see a lot of people on my Twitter account mentioning stocks that they're interested in. So today I've also taken the opportunity to analyze a little bit of Bristol-Myers. So stay tuned. This is what we will discuss today in the show. And yeah, let's get started. So quarter one has just ended. It's now, I think, 5th of April, yeah. And I'm really proud on the first quarter that I had. And let's start with the most interesting picture for me that I'm looking at. So what this portfolio goal progress shows is the amount of money that I've accumulated as the value of my portfolio compared to my target value that I think I need with a certain yield to be able to retire early. So look at the difference a year makes. Last year in March, we had, of course, a steep decline. That's when I decided to buy a lot of stocks by pulling money from my war chest. Just this situation in March and April last year has allowed me to grow my income with more than 10% when it comes to my portfolio goal progress. And I want you to know that the yield has been growing in lockstep with it, because my current portfolio yield is 3.35%, which was last year around this time, I think 3.5, 3.6%. So yes, there's been some multiple extraction here in my portfolio, but generally, this is awesome. I mean, I didn't expect that the impact of doubling down last year during the market crash would have such a significant impact on my portfolio performance. I'm really, really proud on this. If you then also look at my portfolio grow year over year, it has grown 15%, which is really a lot. And you can see that also in the net dividend income. So the income compared to January last year was 47% more, February 17%, and in March 33%. You need to know that March is my biggest income month in this quarter. So 30% overall is really an awesome number. I mean, I thought that the high numbers already kicking in here in the portfolio would start limiting actually the uptick in my portfolio. But what is nice, I'm actually seeing the impact of compounding now, because this also includes all the reinvestments of dividends, and they start to really matter now. So you can see this has been a journey of 6 years already. If you're just in the beginning of the journey, don't worry. Really, its time is on your side. It really starts to pay off. And I can see that every time reinvesting these dividends have been a large contributor of my portfolio growth. It's not just the monthly savings rate anymore at a certain moment. It's the dividends that you're reinvesting on top of that. So what did I acquire this year? I think people that follow me on social media are pretty familiar with it, but I bought 2 times a bunch of shares in Realty Income. 3M, you saw the other video from me on that. I will put the description also and the link in it in the description. Unilever, I added more to my position there, and Ahold, which I found really attractively valued. And you have also seen the other video probably, but if not, I will put the link also in the description here. I continue reinvesting my dividends in Shell every time. So I went all the way through the bottom. I kept reinvesting, and the share count keeps growing while the share price is also nicely recovering. Another thing that you can say is definitely that in quarter one, it was the return of value stocks over growth stocks, because generally, I think many people in the dividend growth investment community have seen their portfolios really grow over the first quarter, while we saw people on Twitter and such and social media that were heavily invested in growth stocks having a bit of a worse quarter than us. Having said that, I hope that the time for value investing returns, but not too quick, because, what it also means that it is harder and harder to find outstanding value here. But hey, that's what we will address in this show as well, because we will later look into the healthcare sector. So all in all, I'm really, really excited with the first quarter that it brought with me. I'm really happy with some high quality dividend companies that I've been able to further accumulate. And yeah, I don't expect a similar quarter two like this, because the stock market is really pricey. But like I always say, It's not a stock market, it's a market of stocks. I will continue looking for those undervalued companies that I want to add into my portfolio. So having said that, let's go a little bit into the chip wars, because it's really getting exciting right now. So remember what I pointed you out last week? Intel was going to invest 20 billion to invest in 2 new factories to support their foundry services. But bam, there comes the Taiwanese TSMC, and they have announced to invest 100 billion. Actually, this was not new. When I did my research, I learned that they actually announced it already in an investor conference early in January, but they just hit the news right now. 100 billion, and just 28 billion already this year. Now, I mean, I'm quite excited about Intel and their turnaround plan, but don't be mistaken who's the real leader here. This for me really TSMC at the moment. 100 billion is insane. And what I find really interesting, it shows just how much Intel is behind. And one of the things that I really like to look into is ARK, because they have great reports around their big investment IDs. And one of them is around the data center. And I know the chip industry is far beyond the data center, but this just shows like where the problem of Intel is and why it is lagging TSMC really behind them. So let's just look at what is happening here. And I think Dividend Wave also showed this picture on Twitter. So if you don't follow him yet, please follow him. I will also put his link to his Twitter handle in the description, because he really keeps a close eye on this chip wars. But look, this was Intel, and look at the lag. Yeah, it took them literally 4 years to come to execution on 10 nanometer, and they're still behind. But TSMC is already mass producing 5 nanometers. They are so behind in this, and that's why it's so important for Intel also to work with TSMC. And for me, this is the chip wars, and just in daylight. It's so heavy at the moment, and so much money involved. Well, there are many companies that you can invest here, because, for instance, who are building the machines for these producers? So you can look at ASML here, but everything feels really pricey. And the only value play that you could have here, I think, in my opinion, is Intel. But Intel really needs to turn around the ship. So when talking to Dividend Wave, what he did is really nicely create an overview of all the companies that are in this space and how they are aligning here with Intel, how they are collaborating with Intel. So, and here's what I mentioned with ASML. But what is missing here is Apple. And this really becomes also interesting, because another announcement here that has been made is that Apple will start, producing 3 nanometer chips by the end of this year together with TSMC, and they're sharing the risk. I mean, I just mentioned about 5 nanometer. They're already looking in 3 nanometer, while Intel is still trying to develop 7 nanometer. It's no surprise that they need to be supported by TSMC also for a part of their production. And what I find really interesting is the comment from Pat Gelsinger about Apple on their investor conference last week. And I'll play a piece of this. Listen up.
Competitive fun going on with the Apple and the Mac ecosystem as a result. At the same time, Apple's a customer, and I hope to make them a big foundry customer, because today they're wholly dependent on TSMC. And we want to present great options for them to leverage our foundry services as well, just like we're working with Qualcomm's, NVIDIA's, and Microsoft.
Okay, I think you get the point. So they really hope to get Apple back as a customer, and because they are solely dependent on TSMC. Well, we just saw the news. Don't have too high expectations. Please don't model in your Intel investment plans at the moment, if you want to own the company, that they will get Apple back that easily. I know that he's talking about foundry in specific, but where the real innovation is happening, where the real edge for Apple is having the best iPhone, the best iPad, the best MacBook. TSMC is leading this, and I don't see Intel coming any close in the short time. So please don't get your hopes high. Intel is a turnaround stock. Intel has the foundry business where it can earn a lot of money because of the chip shortage. There's more than enough market there, but it's not on the leading edge. And that's why it deserves a low multiple. It's nice to collect your dividend in the meanwhile, because their cash flow is rich. But wow, the chip wars are really full blown. And I'm becoming more and more excited about this sector. And actually, if I look at it, I find TSMC way too expensive, ASML way too expensive. If I see at the future growth forecasts of the chip industry, really, if Intel drops one time below 50 euro towards $50, $45, I know it's maybe wishful thinking. I might enter a position, but yeah, this is really getting excited here. And, let's see where this brings us to. Okay, so let's go to the third topic then, and that's about the healthcare sector. Why I chose this sector in particular is because I get a lot of people that recommend stocks on Twitter at the moment, really recommend sectors like big pharma companies. So I was wondering, okay, so is besides the insurance industry that I had a post about like 1-2 months ago, is the healthcare sector also heavily undervalued? Well, to look into that, I always like to go to Guru Focus because it gives all these sectors really nicely split and their valuations using valuation metrics. So if we go here to Guru Focus Industry Overview, you will see here that what the PE ratios are per sector, let's say, and per industry. So if we look at overall, I would say that the healthcare sector is definitely not undervalued because it has a really high PE. And if we dig a little bit in why this is, then you can see that the PE is really high because of, for instance, the medical devices and instruments like industry. For instance, Philips, Medtronic, these are all part of this. And it's keeping it up. Yeah, it's keeping it really high. But one of the companies that I often get recommended are part of the drug manufacturers industry. And if we go into the drug manufacturers industry, you see that this is much better value, but not all of them. Not all are equal because we know that Johnson & Johnson is quite expensive right now. But Pfizer is often brought up. Merck is often brought up. AbbVie is often brought up. But today I wanted to go also with you in Bristol-Myers because this is probably the ticker symbol that I have seen most of the times being, commented on when I put something on Twitter. And it's all the time big pharma and often Bristol-Myers. So it made me wonder, what is so attractive currently to Bristol-Myers? So what I'm going to show you soon is a little bit of business background behind Bristol-Myers Squibb and also my valuation. But to go back to the drug manufacturing industry, I personally believe it's not really an undervalued sector or industry at the moment. I find it quite pricey. But again, I mentioned before, this is not a stock market. It's a market of stocks. And this is why I love investing so much, because definitely in the pharma industry, there are definitely some pharma companies that are currently really attractively valued. Okay, so let's get into Bristol-Myers. So if we look at Bristol-Myers, what is really interesting is that if we look at the 5-year share price history, that the stock was effectively dead money. If you bought it here early on in 2016, let's say, you've not really earned a lot and you've missed out at least on a lot from capital appreciation. But of course, if you would have reinvested the dividends, I'm sure you would have seen a nice exponential growth in it as well, because this is really the power of compounding interest. But from a share price appreciation, not going really anywhere. What we could see here is that around the Celgene acquisition in 2019, the share price did really well. Then in March, it collapsed quite back, but then you can see it's slowly picking up again. Okay, but let's look now a little bit into Bristol-Myers history then, because the company has been around already for 134 years. But, what is really interesting here is the phase 2000 to 2010. It was scandal after scandal after scandal. So in 2002, it started with their monopoly on Taxol, its cancer treatment, 125 million settlement. But here as well, an FBI raided the company in 2006. Again, centered on the distribution of Plavix and charges of collusion. I mean, it's insane what was happening there. And again, the board of directors looked really, really bad there. And also, again, settlements here. So here, look, under CEO Jim Cornelius, who was CEO following all executives involved in the channel stuffing and generic competition scandals have since left the company. A major cleanup has happened. And this is also why we can see, if we look at Bristol-Myers Squibb, that they only have 12 years of dividend growth, because usually these companies have like 50, 60 years of dividend growth, or at least are close to being part of the dividend kings, but not Bristol-Myers. Scandal after scandal after scandal. But I would say since 2010, the new decade, they have left that behind them. And this is a similar story like to Ahold Delhaize, which also had a major fraud in the early 2000s. So it takes some years to come clean as a company. But I believe that since then, they have found their own path to moral growth back again, let's say. So yeah, very interesting company, and since 2010, and specifically in the last 2-3 years, they have done some really nice acquisitions, and you can see that here as well, because look at the acquisitions that they have been doing: Flexus Bioscience, Cardioxil, but Celgene is really their major acquisition, and actually late last year also Myocardia, and I believe they have it written here, so they have purchased Celgene here for 74 billion, but 95 billion including debt. This is one of the biggest acquisitions in modern history by companies. And the Myocardia was also not a small acquisition by 13 billion. And this is what we will soon see if we also go into their into their annual report, because we will see what the impact was of these numbers on the balance sheet and the income statement as an example. But before we start there, what I think is always really important to do is to understand the business well. And if you go to the Bristol-Myers investor webpage, I'll show you where to find such things. So typically, what you want to look at in the healthcare sector is I believe it's the JP Morgan Health Conference that was in January. And let me see, was it JP Morgan? Yes, in JP Morgan Healthcare Conference. This is the annual conference, which is really important, I think, for people that are investing in healthcare companies. So what I would recommend here to do is to view their presentation, and I have it opened here already, and just read it, because here you see the strategic ambitions of what you really want to know also from an investor point of view. Because if you only look at the cold facts in the 10K and you look at all the pages, you will not easily find it. Now, some highlights here in their report. And what I find really important, because when you're looking at a company like Bristol-Myers, you know that they're earning a lot of cash flow now. The issue typically is with their biggest drugs and how they are going to replace the drugs pipeline. What you want to see here is a lot of innovation, because typically, if you think about it, if they have, let's say, 20 drugs under research, maybe only 3 or 4 in the end see daylight and really earn the company revenue that is meaningful. So you want to see a rich pipeline, lots of licensing deals with other companies, so that for instance Bristol-Myers can look after the drug manufacturing and the marketing to help the small companies that don't have the scalability but that might have this breakthrough drug in their pipeline. So, and this is where it looks actually quite good for Bristol-Myers. They have a lot of things going on, and if you go here into the report, you see here what they are looking at. So, by 2025, they expect to have a portfolio, renewal of around 30% coming back into their business. And when we go further in the future, you will see that it will only grow. So this is important. They are expecting enough launch, and you need to know that this launch that they are expecting is already taking into consideration their success rates, and that's what they calculate. So what you want to see is that, for instance, it's okay if some FDA approvals are not granted, but you need to understand where the company is thinking about that, about the risks and such associated to those drugs, in which stage they are, and you can find that in their 10Ks. So another one that I then want to look at is their capital allocation approach, because you can imagine after 95 billion acquisition of Celgene, another 13 billion, that is more than, it's 110 billion being acquired. So you want to see also what their capital allocation strategy is. And I believe they have it, let me see, they have it here. So at the moment, you will see the cash on hand is a little bit less, but they expect around 45 to 50 billion of free cash flow over the next 3 years. They also expect to bring forward up to 4 billion additional debt reduction in 2021. So they are actively focusing on deleveraging the balance sheet. And this is really good, because it does impact our valuation, right? The less debt on the balance sheet, the less debt we need to deduct from the intrinsic value of the company. Because we are interested in, the equity that is left to us as investors. That's what we really own. We don't own the debt. the debt holder, the banks have a first right on the debt. But what I also really like here is that they are intending to keep on doing share buybacks. So the question then is that wise right now? We will see that soon when we look at the valuation. But I think it's fair to do that from their point of view. So, and they want to do an additional 3 to 4 billion debt on top in total here. So a lot of debt repayment. In my opinion, they are aiming for, because you need to be able to cover this all with cash, plus share repurchases, plus dividend payments. I'm quite happy with this, with their plans, looking at it from a shareholder perspective. But what's always good to see is that their business development stays top priority. And of course, this is easily said by the company. But if you go further through this report and you see it, what they are trying to do with their 50 assets, I do believe that they're really doing the right stuff here. So, in my opinion, it's a company that did some really bold-on acquisitions, leveraged on debt, is going to use the cash flow to pay down debt while retaining the dividend as well and improve and growing the dividend. So for me, these are all the right sound bites that what I want to hear in a strategy as a dividend growth investor. But then let's also look a little bit at their recent performance. So what is important to know, in the fourth quarter, they had a share loss of 4.45, so $4.50 per share, and a non-GAAP EPS of $1.50 per share. A full year loss of $4 and a full year profit, a non-GAAP of $6.50. What is important here, and I will show you that in the income statement, is that there have been major write-offs based on Celgene acquisition and the MyoKardia acquisition. So let's look into that a little bit. So if we look at the income statement, you can see what the impact was of the acquisition of Celgene. Their income, their sales went up from 25 million to 41 billions. So that's a 16 billion increase, which is quite significant. But here you see it already. I think it's the in-product and research and development, in-process research and development charge from MyoKardia. So when you acquire a company, you might need to write down on that, and that's what they've done. That's an 11 billion charge. At the same time, they had an amortization of acquired intangible assets from Celgene, also almost 10 billion. This is why the company was having a 9 billion loss, or similar to $4 earnings per share. Now the question then is, what do you need to do with this? Because what you will see is that in general, when we look at research and development here, 11 billion, 6 billion, there will always be write-offs on this. And this is normal for a company. And they're typically taking it out of their non-GAAP earnings. So later on, I will show you what I did with this, with the discounted cash flow as well. If you want to know exactly more what happened, why this is and where this is explained, you can always go further into the earnings report in 10K. And here you can see also the explanation of where those posts in the income statement are resulting from, because it's not always clear, right? Not everyone, if you look back at I said at here, it doesn't say necessarily this is Celgene, but here it becomes clear. So and charges relating to the Celgene acquisition, including amortization of acquired intangible assets, the unwinding of inventory, and tax charges. So, but the main big item is the amortization and acquired tangible assets. Okay, so, when we see these kinds of charges, we will also see that back on the balance sheet. So let's quickly look at the balance sheet. And what you can see here is that their other intangible assets reduced from 63 billion to 53 billion. I believe the MyoKardia is not really visible here because we're comparing 2019 with 2020. So it hasn't been on the full balance sheet anyway from that point of view. What we can also see is that their long-term debt hardly grew, which is really nice because they have been at the same time also already paying off some debt. For me, when I look at it, we're looking here at a pretty nice balance sheet. The debt to equity is above 100%, but I believe if they start bringing down their debt by, let's say, 4 or 5 billion per year over the next coming years, you will see the company quite quickly shrinking their long-term obligation. So I'm fine with this. This is normal after such a large acquisition, but it now comes down to that we in the annual report, in the upcoming reports, really start to see meaningful deduction. Not that they are reducing their debt, but at the same time, for instance, doing share dilution and such, or taking debt in for other things again, which don't really add value to the company. So we need to pay an attention to that. If we then look at the cash flow, the first financial statement that I always want to look into. I want to know what they have been really earning. So if you look at the net loss from earnings, you will see that the IPRD charge is brought back again. The amortization is brought back again, because those are not cash impacting, how is it? Events. These are bookkeeping events. So if we look at the cash, that's really, so if we say cash is king, is really important here. You can see that they had a free cash flow of around 13 billion in 2020, which is a lot of money. Remember, they are aiming to buy back shares of 2 to 3 billion. They are aiming to reduce their debt by 4 billion. So let's say 7 billion. Plus dividends, 4 billion, that's 11 billion. So around 2 billion can go back to their cash reserves. If you would do it like that, if you would keep calculating like that. And here you see it, increase in cash equivalents, 2 billion added here. So for me, this is a company that's generating massive cash flows, and it needs it now to use their capital allocation approach. So for me, what I've seen on the slides in the BMI, investor conference presentation is reflecting in the numbers. So what is really important here, management is not fooling us, which is a big kudo. Okay, so let's get then back to what I think this company is worth. Let's plug in these numbers. So what I will do is I'll put the link in the description here. This is my calculator for the valuation of a company using a discounted cash flow calculation. So important here, they had almost 2.3 billion shares outstanding, cash on hand 14.5 billion, free cash flow. What I did here, and this is important, I looked when you remember the income statement, what I showed you there. They have around every year they have around a charge of 6 billion in the amortization because of research and development, which was not successful. So they're impairing on their intangible assets there. I'm deducting that here because this is a continuous thing every year. I believe it needs to be in there. And hence, I'm blending here a little bit the income statement with the free cash flow statement. If I keep having this out of it, then I'm not showing the management effectiveness really. And I find it really important for me also for the discounted cash flow calculation to take that into consideration. We saw the long-term debt is 48 billion here. Well, my baseline case is 7% growth over the upcoming 5 years and the 5 years afterwards 4%, and with a discount rate of 6.6%. Terminal multiple 17. I believe a company like this should trade around the multiple of 17 here. Optimistic case, you see the numbers are a bit up with a multiple of 21%, but I don't see this really likely, hence why I give the small percentage. However, I can rather see a bearish case, that the numbers are not really hitting it, that they have some more FDA issues by not getting all the approvals, hence the growth will be less. And then you see the numbers are lower again. So if I plug in all these numbers, you will see what the cash flows are per year. We add them all together. We add the terminal value. That's the latest cash flow times the terminal multiple that we gave. We put it on. We add the cash on hand. We reduce the total debt, and then we see a fair value of the company of 150 billion. Dividing this by the amount of shares outstanding will be $65. So if we then take in the probability of this, you can see the probability for the baseline case is $65, for the top line case 91, and for the bearish case $40. You need to be really aware of this because I might be wrong in my assumptions here, and then your returns will be looking much weaker. Having said that, I believe that the fair value per share is $61, which is quite slightly under the $63 that it's trading for now. Having said that, I prefer to buy undervalued companies when I go big on them. So for me, if I really want to add a lot to my position, it would need to dip just below $50. However, I might consider, based on the current share price, I might consider maybe nibbling in and starting a position in Bristol-Myers, but I would need to do further research because there's an opportunity cost related to it. There might be other companies that are more attractively valued at the moment, but it will be now my watch list going forward because I find it a really interesting company. They have done bolt-on acquisitions. They have really, really rich free cash flow, great capital allocation strategy. So from that point of view, I find it a really interesting business, a well-managed company. I would just need to compare it with other companies from an opportunity cost point of view. So this was my story. It was a bit of a longer show, I think, because I did quite an analysis still on Bristol-Myers. I hope you enjoy these kinds of Sunday with eDGI episodes. I will try it for the upcoming 3 months. And yeah, if you haven't done so yet, just subscribe to the channel. Give me a like, spread the word, and hey, if you have any questions you might want me to address in the next Sunday's episode, then also feel free to put in the comments, whether it's a stock that you want to have your opinion on, whether you want me to explain something more about dividend growth investing, some basics. I'm all up for it. Just let me know. I might include it into the next video, but for now, have a great remainder of this Easter Monday, and see you next week. Bye.